Welcome to the Becker Professional Education CPE program. Hi everyone, my name's Tim Garrity and I'll be your host as we go through an introduction to employee benefits, part 1. Now in this particular program, after we've completed it, you should be able to recognize the difference between a deferred contribution, a deferred benefit, and a welfare benefit plan. We should be able to identify the effect of government regulations on employee benefit plans and identify the employee benefit plans and audit requirements. This is an overview of the definition of the different types of plans, the effect of government regulations, the issue of internal control over service organizations, and audit requirements for employee benefit plans. Now, we're going to break this into 5 chapters. In Chapter 1, we're going to be looking at an introduction to employee benefit plans, auditing and accounting rules, an overview, government entities, and qualified plans under Section 401A of the Internal Revenue Code. We're then going to jump into Chapter 2 and look at background of employee benefit plans. We're going to look at the Secure Act, defined contributions, and the retirement plans associated with them. Then we'll study the difference between them and defined benefit plans. We'll look at health and welfare benefit plans. So we're going to look at all 3. Then we'll jump to Chapter 3. And in Chapter 3, we're going to look at financial accounting and reporting for ERISA plans, the government regs, reporting and disclosures, and plan pursuant to the Securities Exchange Commission. We'll then jump into Chapter 4 and look at internal controls using service organizations. We'll look at services provided by the service organization relevant to the operation and audit of that plan. We'll look at the nature of service and interaction between service organizations and the plan. And we'll also look at monitoring service organization controls. And then finally, in Chapter 5, we're going to look at auditing requirements for ERISA and ERISA Section 103A3C. Say that fast. Basically, your limited scope audits, and then we'll examine your full scope audits. So let's start with an introduction. Well, there's an overview. Employee benefit plans are required to provide an annual audit both to the Department of Labor, plan management, and the plan participants. Everyone wants to know what's going on. The government wants to know. Management wants to make sure that this is okay. And of course, you as a participant in the plan want to make sure it's there and it's in good shape. Obviously, this is primary purpose is to evaluate the plan's ability to meet its liabilities. In fact, when you have underfunded plans, the concern is ultimately, will this plan ultimately be in existence and be able to give me that pension that I was planning on? Now, ERISA is out there. ERISA stands for the Employee Retirement Income Security Act of 1974. So we're going back almost a little bit close to 50 years ago. And they established the minimum standards in this area. ERISA covers an estimated 141 million workers, retirees, and dependents, and they're handling approximately $7.6 trillion. So let's talk a little bit about government entities. What are the characteristics of a government entity? Well, popular elections appoint the officers. The power to enact and enforce tax levies is part of the government, and the ability to issue debt with interest being paid. And especially when we're talking about municipal and state, then those ultimately are not taxable by the federal government. Now, by the way, the AICPA guide is not intended for guidance on auditing plans of government entities. However, auditors may still refer to them for guidance. Now, qualified plans under Internal Revenue Code 401A. Well, first of all, you set up a trust. So essentially what you're doing is you're setting up a brand new entity. Think of it like a corporation, but you ultimately call it a trust. So it's the XYZ Trust. And in that entity, the whole purpose of it is to ultimately capture all the money as it's being donated in, obviously account for all the earnings that it will have during its period while in existence, and then distribute money to the appropriate parties at the appropriate time. Now, you'll notice here the United States forming part of the pension, in this case, profit sharing or stock bonus plan, solely for the benefit of employees, right? This is for their benefit. Now, ultimately, in this case, it's considered a qualified trust under the Internal Revenue Code if the following requirements are met. And we have got 12 of them. Number one, contributions are made by the employer and or the employee. Some are going to be matching, some are only the employer, some are only the employee, with the intended purpose of eventually distributing the earnings to the employee or possibly a beneficiary if they don't survive. The second item, it is impossible for the trust to divert the corpus or the income for any other purpose or satisfy any of, say, the company's liabilities. Number three, the plan must meet minimum participation standards as provided in Section 410 of the Internal Revenue Code. The plan is considered in compliance if they are satisfying that criteria for at least one day during each quarter. So essentially what we're going to learn is most plans have what we call a top-heavy issue. In other words, you can't set up a plan where only the top 3 or 4 executives get all this money, and obviously the rank and file don't get anything. That would be a top-heavy plan. And there's a lot of extra hurdles they would have to go through before any plan like that would be allowable. Number 4, contributions and benefits may not discriminate in favor of highly compensated individuals. In other words, the top dogs. The plan must meet minimum vesting requirements. Typically, maybe it's you have it vested right away. Sometimes there's a period of time that you have to do it over. Notice number 6, a defined benefit plan. And we're going to discuss what the distinction is between a defined benefit and a defined contribution in just a little bit. But a defined benefit plan will not qualify unless the plan indicates that forfeitures will not be used to increase employee benefits under the plan. Number 7, required distributions must occur on the required beginning date for each plan. Now, generally, it's when they retire, providing that they're over 59 and a half. So it's when they retire or when they hit 72 under the required minimum distribution. We're going to see that over and over again as we go through the plans, especially near the end of this program. Number 8, the plan must meet requirements related to joint and survivor annuities and pre-retirement survivor annuities. Number 9, the plan must meet requirements related to top-heavy plans in which the contributions and or benefits are for employees who are also owners of the business. So you can't have a plan where it's, well, the owner is going to be able to have a matching contribution of half of what they put in. Employees, oh, you only get 1%, right? Obviously, the government doesn't want that to occur. Number 10, the event of a merger, consolidation, or transfer to another plan, each participant's benefits must be at least equal or greater to what they were before. So you can't use that as a scheme to obviously lower the benefits to individuals. Number 11, benefits cannot be assigned or alienated. And finally, number 12, the plan must adhere to distribution requirements, compensation limits, and you're going to see that sometimes the limit is 20-ish thousand. Other times it's going to be in the 50s or 60,000. And also typically it's the lesser of that or a percentage of compensation. Now, notice qualified retirement plans are covering broad groups of employees. Non-qualified, notice the difference there. Non-qualified retirement plans cover only a small number of key employees. So with that basic understanding, let's go take a look now at a fundamental item, and that would be the following: background of employee benefit plans. We're going to talk a little bit about the SECURE Act. And by the way, what does SECURE stand for? Setting Every Community Up for Retirement Enhancement Act. And this was enacted in January of 2020. Notice, it raises the minimum age. It used to be 70 and a half. Now you don't have to start taking your money out until you're 72. And the logic there is that more and more people literally are working longer and longer. Maybe it's because they're worried about living longer and they want to make sure they don't run out of money. Also, you're healthy, you're sharp mentally. Why not work? And of course, contributions to individual retirement accounts, your IRAs, are no longer age restricted where you can't make contributions after a certain age. If you're still earning money and you want to put money into your IRA, you're certainly going to be allowed to do that. Now, persons can make an IRA contribution in any year in which they have earned income. Now, of course, the IRA requirements are also, you're not involved in a 401k and your income level is below a threshold amount, right? There are some conditions in order to qualify. Now, when a non-spousal party, think of your children, a significant other but not a spouse, are the beneficiaries, the entire inherited amount must be distributed within 10 years of the owner's death. Now, investment providers must issue estimates of potential monthly earnings from the purchase of joint, survivor, or single life annuities. Remember, an annuity is where you give a lump sum and then you automatically have a guaranteed monthly amount for the duration of your life. Now, just as a simple idea, what happens when you give that? Every time you get the payment, do you have to include that in income? And the answer is no. You take your original contribution divided by your actuarial expected life, and that amount every month is a return of your basis. That's tax-free. The additional amount is going to be the amount that's taxable. Well, what happens if you outlive your actuarial life? Then all the payments wind up being fully taxable. What happens if you die before your actuarial life? Well, then the amount that you didn't recover is allowed as an itemized deduction, not subject to any AGI threshold. You can take the whole amount if you itemize. Now, part-time employees, as long as you've put in 3 years and you've had an annual 500 hours, then you must be considered eligible for the 401k of your employer. Well, we're going to look at 8 different defined contribution plans. And I think this is a good time to kind of explain the difference between a defined contribution and a defined benefit. Defined contribution will define the money you're putting away. Whatever it grows to, well, that's going to be your problem or your benefit. You actually get the choice of what to invest in because ultimately you're assuming risks and rewards. So we define the contribution. Maybe it's $18,000 or $20,000 or $21,000 a year. Well, it's going to be put in, but there's no guarantee that it'll be enough for you to live on. It's just whatever it is, when ultimately you retire, based on the investments you chose and what they earned or lost, is yours. That's defined contribution. Defined benefit usually seems a lot better. This is where it says when you retire, assuming you met certain vesting requirements, like you worked here for 20 or 25 years, and you reach a retirement age, usually 65, we will start paying you X amount of money every month, no matter what. It's us, the company, that takes on all the risk of figuring out how we better have enough money to cover your retirement. So it may be 2/3 of your salary. It may be, 75% of your salary, depending on how you vested, how long you were there. So that's a defined benefit. Most people would prefer that because there's kind of an assurance that you're at least going to always get that amount no matter how long you live. And I haven't met a client yet that I serve who isn't worried that if they retire, will they run out of money and still be alive? And then what will they do? So obviously this is a big item. Now, if you have a defined contribution plan, you could withdraw a lump sum and roll it over into an annuity so that therefore at least you have a guaranteed amount for at least some of your proceeds for the rest of your life. Now, the 8 plans that we're going to be discussing are a profit sharing plan, a 401k, that's the most popular that most of us know about, a money purchase plan, an ESOP, an employee stock option plan, a 403b, that would be for people who are literally teachers at local schools. In fact, my sister, that was what she retired on, is a 403b. You have your 457 plans, your SEPs, and your KESOPs. We're going to look at each of those over the next couple of minutes. Now, the defined contribution plan, that's the one where the money goes in, you ultimately get a lot of say in what it's invested in, and whatever it is when you retire is what it is. Notice the benefits are based on the following: the amount that was contributed, the investment experience. Hopefully it was earnings, but there may have been losses if you invested in stocks that went down, and any forfeitures allocated to the account, and then, of course, minus any administrative fees. Well, let's go to the first one, and this is your profit sharing plan. This is a defined contribution plan that does not meet the requirements of being a money purchase pension plan or a stock bonus plan. Now, under this profit sharing plan, companies contributions may be discretionary. So they may one year and maybe not the next. Contributions may be based on a formula, like a percentage of profits will go into it, spread out amongst everyone. It may be a percentage of your compensation, or it may be other factors. Now, only employers contribute to this type of plan. You'll notice the types of employers. Well, it's good for just about any company. And you may establish a profit sharing plan, or a profit sharing plan can be a good plan if cash flows are an issue. Because as I said, contributions are discretionary. One year you can put it in, the next year you can decide not to put it in. Now, clients that we have who have these plans typically feel an emotional obligation to put at least some money in. But they'll explain if they're not putting in the full amount based on ultimately a hard year like COVID-19's 2020. Now, general distribution rules, loans may be permitted based on the plan document, so it's all up to the plan. Employees can make withdrawals during employment. However, those withdrawals are taxed at an additional 10% if the employee is not at least 59 and a half. That's usually the minimum age to start taking money out and enjoying it. Now, the required distribution rules, this you're going to hear quite a bit. The plan must make distributions to participants on required beginning dates as either a lump sum, they can take out the whole amount, or as monthly periodic payments. The required beginning date occurs on April 1, the year following their retirement, or when they reach the age of 72, whichever occurs later. That would be when you have to make the distribution. So therefore, in this case, you may have retired at 65 and decided you don't want any money until after 72 because you got another job, or maybe your spouse is still working, so you're in still a high income bracket. Now, contribution limits, contributions may not discriminate in favor of the key employees and highly compensated people. The maximum contribution for the current year is the lesser of 100% of the compensation, or you can see the limit right there for the year in question. Now, every year they index it and they adjust it. Now, employers can deduct amounts not to exceed 25% of the aggregate compensation of all participants. Let's take a look now at the second plan, the 401k, probably one of the most popular that we all know about. The type of profit sharing plan that permits employees to contribute money through elective deferrals, right? This is where you make an election every year, typically in, let's say, like October. The company's HR department will send out a notice saying, hey, it's time to make your elections for next year, and you must make them by X date. So all of a sudden you say your 401k. Now, you can pick up to the maximum, or you can pick a lesser amount if times are tough on you financially and you decide this year I don't want to put in the full amount. Now, general distribution rules, loans may be permitted based on the plan documents, and generally, in order to qualify for a distribution of elective deferrals, one of the following must occur. One, death or disability occurred. You were terminated. The plan terminates with no successor. You reach the age of 59 and a half. Notice that's always the age that we are allowed to start taking it out without the proverbial 10% penalty. And participants face a financial hardship. Now, the required distribution rules, this is going to sound familiar. It's when you retire or when you hit the age of 72, whichever is later, is when they would have to start giving it to you. Contribution limits. The limits are again adjusted every year, and as you can see, it gets indexed. At one point, it was 15, then it was 17,500, 18, 25, 20,500, and so on. Now, the plan contributions per participant may not exceed your compensation, and if you'll notice for the current year, $61,000, or there's a catch-up provision of $6,500 if you are age 50 or older. So as you get closer to retirement, your income's probably doing better. You may be scaling down as far as spending is concerned. So therefore, more of your income can go into the pension at this point in time. So you may elect that. So here's an example. Both an employer and employee may contribute. Most companies will have what they call a match, which says if I'm going to put in $20,000, they may say, well, we'll match the first 4%. So they'll put in a certain amount and they get a deduction for it. So an employee elected deferral is limited, as we said, to $20,500. For example, the employer may offer a match on contributions up to 4%. So therefore, ultimately, they would sit there and determine that percentage and they would match it. So they're not putting in the same amount, $20,500. That'd be great if they did. But more likely than not, it's just a small percentage. By the way, many companies during COVID-19's prime time, 2020 and early 2021, stopped the match. They didn't have dividends. They didn't have matching on the 401ks. They didn't buy back their stock. They furloughed employees. They managed cash very frugally. The third one is your money purchase pension plan. Now, this is the company contribution is based on a fixed formula, not related to profits, and listen to this, is mandatory according to the documents. If a minimum contribution is not met by the employer, which was mandatory, then an excise tax will apply. Employers or employees can contribute. Now, the type of employer, it can be companies of any size. General distributions, loans may be permitted based on the plan documents. Withdrawals are not permitted while a participant is still in service. Now, the required distributions, I bet you this is going to sound familiar. It's when the participant retired or when they reach the age of 72. There's your required minimum distribution, whichever is later. Participants can take a penalty-free in-service distribution of $5,000 for each spouse within 1 year of the birth or adoption of a child. Maximum contributions, well, it's the lesser of 100% of your compensation or $61,000. Now, that will be adjusted every single year. Now, employers can deduct amounts not to exceed 25% of the aggregate compensation. Contributions are mandatory and based on an established formula, as we said, and there's an excise tax if you don't make that contribution. For example, it may be 10% of the employee's comp. Notice it's not based on profit, it's based on other factors. The fourth of the 8 items remember, these are defined contribution plans, is your ESOP, your employee stock ownership plan. Now, the description, it's a retirement plan in which a company contributes stock or money to buy the stock in the plan. Now, the types of employers, primarily companies that are publicly traded. Since you're going to be buying stock, obviously it's a publicly traded company, so you know the value. Private companies, you wouldn't know what's the value of the shares of stock. And the employees may not want, first of all, to become owners, minority shareholders in a company that's run by a family. And also the family may not want to dilute their ownership. Now, general distribution rules, this is going to sound familiar. Ultimately, by April 1 of the participant's retirement or age 75 or 72, whichever one is later. By the way, contribution limits cannot discriminate in favor of highly compensated employees. The next item that we have right here is going to be your 403B plans. Now, the description, these are tax-sheltered annuities that permit both employee and employer contributions. Now, the types of employers, only public schools and certain not-for-profits. Your 501c3 tax-exempt organizations like churches are permitted to establish it. So my sister, who was a public school, grammar school teacher her whole life, she was participating in a 403B. So when she retired, this was the guaranteed amount she would get. Notice general distribution rules. Distributions from deferrals may only be made in the following circumstances: death or disability, employment termination, employee hardship, or once you reach the age of 59 and a half. Minimum distributions have to be made once you retire or once you hit age 72, whichever one comes later. That would be when you have to make them. So notice right here, literally, you may have been still working and you were 74, 75 years old. You're not required then in this case because it's the employer's termination or 72, whichever comes later. Contribution limits, $20,500, similar to your 401k, and it may not exceed the employee's compensation. You'll notice right here, or 61,000. This amount is for 2020. Amount is periodically adjusted. And by the way, there is that catch-up 6,500 that we mentioned a little bit earlier. The sixth of these is ultimately your Section 457 plans. These are sponsored by governmental entities. These employees would not be eligible for a 401k or a 403b, and they are not covered by ERISA. We're going to talk about ERISA and auditing standards in one of our subsequent chapters, Chapter 4. Contributions and earnings are not tax deferred. Now, the types of employers would be state or local governments or IRC, Internal Revenue Code, Section 501c, tax-exempt organizations. General distribution rules, hardship distributions may be permitted based on the documents. Minimum distributions are no later than April 1 of either the year you retire or when you become 72, whichever is later. I know that sounds redundant again. Contribution limits, total employee and employer combined contributions are limited to $20,500 this year. Now, additional salary reduction contributions are allowed for ultimately if you're 50 or older. There's that $6,500 additional amount you can put in called a catch-up adjustment. Number 7, simplified employee pension plans, your SEPs. The description, it allows an employer to make contributions to individual retirement accounts, like an IRA, established for employees. Now, the owner is also considered an owner if he or she receives compensation from the business. Notice, to be eligible, the employee must meet both of the following. They have to be at least 21, and they had to work for the company 3 out of the last 5 years. The type of employers, it can be any kind of company, any size, and even self-employed. Now, the general distribution rules, the minimum is obviously beginning no later than April 1 of the following year after you turn 72. There's your required minimum distribution. Now, participants may use the IRS Uniform Lifetime Table to determine that required minimum distribution. So hypothetically, I've turned 72, I already retired. We go and look at the actuarial table, and hypothetically it says I've got 240 months to live, according to the actuarial table. In other words, 20 years. Well, then I would ultimately take the amount that's in there, divide it by 20, and I'd have to take that amount out. And that would, of course, be taxable. The next year I take the remainder out. I take the balance that's still there, divide it by 19, and take it out. Now, contribution limits must be made by the employer only and are limited to the lesser. Notice the contributions are made by the employer into this plan. 25% of the compensation, or notice $61,000. So if you happen to be somebody who's making, $300,000, 25% would be 75, but it's the lesser of that amount or the 61. And remember, once again, you're going to be looking at the lesser of those twos. Now, elective deferrals and the catch-up contribution are prohibited since the type of plan is exclusively the employer funding. That's why there isn't an additional $6,500. It's the employer who's making the contribution, not the employee who's deferring it from their income. That's why there's no catch-up here. And finally, we have the case-up. That is ultimately going to be your plan, which is kind of a combination of an ESOP and a 401k. Notice the types of employers are typically publicly traded companies because a lot of it is going to be dealt with as stock. General distributions will be ultimately April 1 of the year after you retire, or the age of 72, whichever comes later, is when the required minimum distributions would occur. Now, contribution limits. Well, matching employer contributions may be made in stock. That's why a public company is the appropriate one here. And contribution limits are limited to $20,500. So what are the tax advantages of a defined contribution plan? And we've just looked at all 8 that are associated in this area. Well, in this particular circumstance, first, It allows plan income to be exempt during ultimately from federal tax in the retirement trust while it's earning and accruing. You must meet requirements for eligibility and benefits. You must meet coverage limits, and contribution limits are in place. Well, the role in administration and operations of a defined contribution plan. You're going to have a plan sponsor. Usually it's the company, the employer. The plan administrator ultimately is maybe an outside party, and they would be responsible for carrying out the legal requirements, including disbursements, record keeping. You have the plan participants, those are the employees. Your audit committee, which would obviously oversee any issues associated with it. Your HR department, which coordinates the enrollment and maintaining eligibility information. And of course, the payroll department. It's required to maintain information to determine the payroll amounts for calculating your contributions. Now, outside service providers may also be used for a defined contribution. You may have a trustee, an investment custodian, an investment manager, an ERISA legal counsel, or an outside administrator. All right, so that gives you an idea of a defined contribution. Now we're going to jump into a defined benefit plan. Remember, these are probably what I would consider to be more desirable, because when you retire, you know an exact amount that you're going to get every month for the rest of your life, no matter how long you live. Obviously, this requires the use of actuaries to ultimately help us. The accountants can't do it all by themselves. You need to figure out how many people will ultimately work and vest, then how many of those people who vest will live to be, say, 65. Of those who live to be 65, what will be their final salary, so that we can base a percentage of their benefits on that. And then those who live to be age 65 and are vested, how long will they live before they pass away? So how many years are we going to be on the hook to pay them? All of that is going to require actuarial assumptions. So the defined benefit plan is the type of plan that will pay participants a specified amount upon retirement for the rest of their life. Benefits amount is determined by a formula, and it's based on age, years of service, and your compensation level. Notice there are two types of plans, a cash balance plan and a pension equity plan. We're going to study both of those in just a few moments. But in the meantime, what are the characteristics? Benefits are based on actuarial assumptions, your age, the years of service, and your compensation. And you'll hear terms like PBO and ABO. PBO stands for projected benefit obligation. ABO stands for accumulated benefit obligation. They both sound pretty intimidating, don't they? Well, what is an accumulated benefit obligation? That says how much would you be entitled to if your salary never gets changed ever again. So today's salary would be the final salary. Maybe it's going to be in 20 years, but that would be the salary that we're going to base the calculations on. Let's say you're going to get 2/3 of your final year salary. So you would base 2/3 of today's salary. You make no assumptions about raises over the next 10 or 15 years that this employee may have. That's accumulated benefit obligation because you've accumulated that on your payroll. Projected says, hold on, I think that most employees will get raises. It may be only a 1% or a 2 or a 3% raise, but they're going to get raises. So a projected benefit obligation literally would make a projection, a best guess of what the salary will be 15 years from now when you retire. And then they'll base 2/3 of that salary. That's your projected benefit obligation. Now in accounting, for your liability, you're supposed to use the projected benefit obligation. But understand, you may disclose what the accumulated benefit obligation is and say the difference we're going to be making up as they get those additional salaries. Now, the specific benefit is not determined until you finally retire, because it's only then that we know what your final salary was. Somebody may retire at 65, somebody else may retire at 68. They may do this for a variety of different reasons, whether it's retirement, death, or disability. Well, the plan's obligation to pay the benefit is based on the present value of the future benefits. And by the way, this has caused a lot of agita for many companies, because ultimately you look at what you have to pay a lot of your young employees many, many years from now, assuming that they vest, they live long enough, and they start collecting. Well, when you discount it back to a present value, you're using some kind of borrowing rate. And of course, the interest rate in 2020 and 2021 were obviously incredibly low. which meant that the present value was still a really high number. So a lot of companies were showing very high liabilities on their balance sheet because they weren't discounting the future payments at 7, 8, or 9%. They were discounting them at 1, 1.5, or 2%. So be aware that those liabilities may have expanded compared to prior years, but it's all because of the discounting formula. And of course, you use current compensation is used to calculate those future benefits. Now, contributions are mandatory, and they're based on an established formula. For example, contributions may be 5% of the employee's pay for services up to 10 years of service. Now, the difference between the defined contribution and the defined benefit plan, as I mentioned, the defined contribution, you usually get to select. Do you want to put your contributions in your plan into stocks, big companies, little companies, foreign companies? Do you want to put how much in bonds? Do you want to put it all in bonds? Right? You make the decision of risk and reward, because ultimately whatever it arrives at, that experience that occurs, that will be your event. That'll be your amount. Defined benefit says, no, we're going to guarantee it. So since we guarantee it, we, the company, will make the decision what we are going to invest in. So an example, in this case, we have the defined contribution is funded based on current information. Ultimately, it's a percentage of your salary not to exceed, say, $20,500. The defined benefit starts with a projected benefit at a retirement based on the plan formula that considers your compensation level, your age and how many more years you have before retirement, how many years of service in the vesting, and then an actuarial calculation is made.